The basic idea of the Merton model is that a company's equity can be viewed as a call option on the company's assets. A firm has assets A and debt L that must be repaid at time T. If at maturity the asset value A underscore T is greater than L, the firm repays the debt and shareholders keep the remaining value. If A underscore T is less than L, the firm defaults and shareholders get nothing. So the payoff to equity at maturity is max of A underscore T minus L and 0. This is exactly the payoff of a call option with strike price L and maturity T. Using this logic, we move to the equity value formula. The value of equity today is given by E equals A times N of D1 minus L times E to the power minus RT times N of D2. Here, A is the current value of assets, L is the face value of debt, R is the risk-free rate, T is time to maturity, and N is the cumulative normal distribution function. The terms D1 and D2 are calculated as follows. D1 equals lane of A divided by L plus R plus sigma underscore A squared divided by 2 multiplied by T divided by sigma underscore A times square root of T, and D2 equals D1 minus sigma underscore A times square root of T. In this model, the main unknowns are the value of assets A and the asset volatility sigma underscore A because they are not directly observable in the market. What we do observe is the market value of equity E and the equity volatility sigma underscore E estimated from historical stock returns. We also know the debt value L from the balance sheet, the risk-free rate R from treasury yields, and time to maturity T. The volatility of equity is linked to asset volatility using the formula sigma underscore E equals A divided by E multiplied by N of D1 multiplied by sigma underscore A. Once we have these, we calculate the risk-neutral probability of default, which is N of minus D2. This assumes that asset returns grow at the risk-free rate, R. However, for the real-world probability of default, we replace R with mu, the expected return on assets. The real-world probability of default becomes N of the negative value of N of A divided by L plus mu minus sigma underscore A squared divided by 2 multiplied by T divided by sigma underscore A times square root of T. The expression inside this formula is called the distance to default. Distance to default equals N of A divided by L plus mu minus sigma underscore A squared divided by 2 multiplied by T divided by sigma underscore A times square root of T distance. To default tells us how many standard deviations the firm's assets are away from the default point. A higher distance to default means the firm is safer, a lower value means the firm is riskier, 0 means assets equal debt, and a negative value means the firm is in the default region. The real-world probability of default is simply N of minus distance to default. Intuitively, assets move randomly over time while debt is fixed. If assets fall below debt at maturity, default occurs. Higher volatility increases default risk, higher debt increases risk, and higher asset value reduces risk. The step-by-step process in practice is first observe market equity value and equity volatility. Second, solve the two equations to find asset value and asset volatility. Third, compute distance to default. And finally, compute probability of default. The model assumes a single zero coupon debt, default only at maturity, asset value follows geometric Brownian motion, markets are frictionless, and volatility is constant. However, the model has limitations because firms usually have multiple debt issues. Default can occur before maturity, asset value is not directly observable, and volatility may change over time.